In March 2023, one of the most powerful banks in Silicon Valley disappeared because of a math problem nobody wanted to fix. This is what happened. Silicon Valley Bank was the bank for tech startups. If you raised a Series A, your money probably sat there. For years, it was untouchable. Then the easy money era came. 2020, 2021, interest rates are basically zero, cash is flooding into tech, and SVB is drowning in deposits. So they do what any bank does. They invest it. But instead of keeping things flexible, they pile into long-term government bonds. That looks safe, right? Government-backed. Can't lose. Except there's a catch. When interest rates go up, older bonds lose value. That's just how it works. And in 2022, the Fed started hiking rates faster than they had in 40 years. SVB's bond portfolio started bleeding billions, quietly, on paper, unrealized. Nobody's panicking yet. But SVB has another problem. Their depositors are mostly tech startups, and 2022 was brutal for tech. Funding dried up. Companies started burning through their cash. Withdrawals pick up. SVB needs liquidity. So in March 2023, they announced they're selling $21 billion worth of those bonds at a $1.8 billion loss, and they need to raise more capital. That announcement was the match. Within hours, the group chats are going. VCs are telling their portfolio companies to pull out immediately. And because this is 2023, banking apps, instant transfers, people actually could pull out right now. $42 billion tried to leave in a single day. The bank couldn't survive it. By the next morning, regulators had shut it down. 40 years, gone in 48 hours. The government stepped in and guaranteed all deposits, above the usual $250K limit, to stop the panic from spreading. But here's the real lesson. SVB didn't buy bad assets. They bought safe assets, government bonds, and still collapsed. Because they ignored duration risk. They locked up short-term money in long-term bets with no hedge and assumed rates would stay low forever. They didn't fail because they were reckless. They failed because they were complacent. And in a world where a bank run can go viral on Twitter before regulators even know it's happening, complacency is its own kind of recklessness.